Imagine a stock that rockets up over 175%, hits an all-time high of nearly $194, and then suddenly just plunges down to the mid-$60. Are you looking at a falling knife with massive sell signals or, the ultimate undervalued buy for the future of energy?
I mean, that really is the defining question right now. It's one of the most volatile, heavily debated charts in the entire market today.
Right, and unpacking that wild ride is exactly our mission for today. So we're doing a deep dive on Oklo Inc. This is a stock that has fundamentally divided Wall Street.
Completely divided. Yeah.
Our goal here is to sift through the noise of the research stack we've got and figure out if this company is a literal value trap or if it represents a generational opportunity. We're going to break down their latest numbers, the highly conflicting technical setup, and some massive insider moves that are, frankly, raising a lot of eyebrows.
Oh, definitely. There's a lot of unusual activity to cover.
For sure. Now, before we jump in, you guys have to keep sending us your feedback on these setups. If you want to keep exploring these deep dives with us, hit that like button, subscribe to our YouTube channel, and it's compulsory that you leave us a comment with your feedback. We really want to know what you think of this setup. Okay, let's unpack this.
Well, the scoreboard is really where we have to start because before we even touch the underlying business, advanced nuclear reactors or AI data centers, the sheer magnitude of the volatility you're dealing with here just requires context.
Oh, absolutely.
We're looking at an asset that yielded staggering gains over the past year, but has simultaneously wiped out a colossal amount of wealth for anyone who bought near the peak.
Yeah, the numbers on that are just staggering.
Yeah.
So looking at the close on April 16th, 2026, Oklo is sitting at $64.21, which is up 1.36% on the day. But if you zoom out to the 52-week range, the low was $19.89.
Right.
Then it goes on this absolute tear to that October 2025 high of $193.84. And now, it's shed over two-thirds of that peak value. What does a chart even look like after a structural collapse like that?
Honestly, it looks structurally broken on a macro level,
Yeah.
but highly complex on a short-term basis. Like long-term trend followers look at the daily chart and they just see this massive multi-wave top from late 2025.
It's pretty ugly.
Yeah, very. It's now in a prolonged bearish correction. The price is trading significantly below its 200-day simple moving average, which is sitting way up at $85.62.
Okay, I want to pause on that for a second because looking at these short-term momentum indicators in the notes, they look surprisingly strong for a stock that just got absolutely crushed.
They do, yeah.
It recently bounced off a support zone between $45 and $50, and it's currently trading above its 50-day moving average, which is about $59.53. So what is actually driving this localized bounce?
Well,
Because if a stock falls from nearly $194 down to $45 and then bounces back to $64, isn't that just a classic dead cat bounce?
what's fascinating here is that a traditional dead cat bounce usually happens on relatively weak volume. It's simply a mechanical exhaustion of sellers, meaning, everyone who wanted to panic sell has already done it.
Right. The selling pressure just dries up.
Exactly. And the price drifts upwards simply because the sellers vanished. But the data from the order flow here shows something completely different. We're seeing substantial volume spikes accompanying this recent bounce off the $45 level.
So meaning big players, or at least highly committed funds, are actively stepping in to buy. They aren't just letting it drift.
Right. They are aggressively accumulating shares. And that is the crucial distinction. Because Oklo has such high retail concentration, the price swings are naturally dramatic. But those volume spikes, they suggest that high conviction traders are drawing a line in the sand around $45 and actively fighting off the short sellers.
Wow.
Yeah, and we can see this reflected in the momentum indicators too. The RSI, the 14-day relative strength index, is sitting between 61 and 67 right now.
Okay, let's translate that RSI for a second for everyone. Think of the RSI like a rubber band stretched between 0 and 100. If it gets over 70, the band is stretched too far to the upside and it's overbought.
Right.
Under 30, it's stretched too far down and is oversold. So a reading in the low to mid-60s means the momentum is genuinely bullish, but, it's getting close to that overbought tension point.
Exactly. And we're also seeing a positive MACD, the moving average convergence divergence indicator, which is sitting at 1.98. The MACD essentially acts like a speedometer for the stock's momentum.
Okay.
So a positive reading shows that short-term momentum is accelerating faster than its long-term historical momentum.
Okay, so we have this massive tug of war where the two sides are reading entirely different rule books. Like short-term momentum traders see the positive NCD, the rising RSI, and that nice bounce off the $45 support.
Yep.
They're playing for a breakout past psychological resistance at $68. Meanwhile, the macro trend algorithms see the stock trapped way below the 200-day moving average. They just see that massive wall of supply waiting around $85.
Oh, absolutely.
Because everyone who bought the dip last year is just waiting to break even and sell.
Which is exactly why the trading algorithms are highly conflicted right now. I mean, the technicals show a literal battleground over price discovery.
So we see traders fighting over the price, throwing millions of dollars back and forth. But what are they actually valuing? I mean, to answer that, we have to open the ledger. And here's where it gets really interesting.
Yeah, the financials are... Oh, well, there's something else.
The audited fiscal year 2025 financials show a multi-billion-dollar company that makes absolutely nothing. Total revenue is exactly $0. They do not sell a single watt of electricity yet.
None. Zero. And the reality of being an early-stage pre-revenue company in the heavy hardware sector is just brutal. The income statement really reflects the immense cost of development here.
I mean, operating expenses skyrocketed.
Oh, totally. They hit $139.3 million in 2025. That is a massive acceleration from just $52.8 million the previous year.
Wow. And that acceleration in spending translates directly into heavy losses. I'm seeing they posted a net loss of $105.7 million for the year.
Yep.
Breaking that down to diluted earnings per share, that's negative $0.72. But the number that really stands out in these notes is the Q4 snapshot. In the fourth quarter, the EPS was negative $0.27, and Wall Street consensus was predicting a narrower loss of negative $0.18.
Right. And whenever an early-stage company misses EPS estimates by that wide of a margin, it triggers immediate anxiety in the market.
Because it means they're burning cash way too fast.
Exactly. It signals that the cash burn is significantly faster than the financial models predicted. So analysts are forced to revise their future estimates downward to account for that burn rate.
Which brings us to this massive paradox on the balance sheet. They're burning over $100 million a year. They missed their earnings estimates. And yet, and this is wild, the balance sheet shows total cash and liquidity of approximately $1.4 billion, with debt sitting near zero. I mean, valuing a multi-billion-dollar company with literally zero revenue is like funding a blockbuster movie that hasn't even written a script yet. But the director somehow has $1.4 billion sitting in a checking account. How does that happen?
Well, they leveraged the one asset they had, their own soaring stock price.
Yeah.
That $1.4 billion liquidity buffer was largely created post-year-end by a massive $1.1 billion capital raise.
Okay, wait.
Yeah, they executed this through an at-the-market or ATM program.
Let's explain the mechanics of an ATM dilution, because this is really the fundamental engine driving the bearish argument here.
Right.
Think of the company's total underlying value as a pizza.
A very expensive pizza.
Right. Raising $1.1 billion through an ATM program doesn't magically make the pizza any bigger. It just slices the exact same pizza into millions of extra pieces. So if you were a retail investor holding a slice you bought at that 193th order line,
The company just took your slice, cut it into a fraction of its original size, and sold the rest into the open market to raise cash.
exactly. So for the existing shareholder, it's just this painful destruction of equity.
It is. However, from a pure corporate survival perspective, it's kind of a masterstroke. Let's look at their guidance for 2026. Management projects using between $80 million and $100 million in operating cash, plus another $350 million to $450 million in investing cash to accelerate deployments.
So they're planning to burn through roughly $500 million next year alone.
Basically, yeah. Now, if they were funding that $500 million burn rate with high-interest corporate debt while bringing in zero revenue, they would be in a financial death spiral.
Oh, completely. The interest payments alone would suffocate the engineering budget.
Exactly. But by flooding the market with new equity while the stock was hot, they completely bypassed the debt markets. Having near zero debt and $1.4 billion in the bank effectively buys them years of runway.
Right. They can just navigate the incoming engineering and regulatory hurdles without facing the imminent threat of bankruptcy.
Yes. The company gets rich and the balance sheet becomes bulletproof.
But the retail shareholder gets their value diluted away in the process. So, okay, we have a company with a massive war chest, zero revenue, and years of highly expensive work ahead of them. With that reality, what are the people closest to the numbers actually doing with their own money?
Ah, the insider activity.
Let's look at it, because the optical narrative here is wild. In April 2026, over $21 million in stock was dumped by key
Yeah,
executives.
and this wasn't a slow trickle from mid-level managers. The chief executive officer, Jacob DeWitt, sold approximately $10.06 million worth of shares. The chief operating officer, Caroline Cochran, also sold approximately $10.06 million.
Wow.
Even the chief financial officer, Craig Bielmeier, sold about $834,000 worth of shares.
Okay, the research notes do point out that these sales were executed under prearranged Rule 10b5-1 trading plans.
Right, which is standard.
Sure, those are automated programs executives set up months in advance to automatically sell shares at predetermined prices, mostly to avoid accusations of insider trading. But I have to push back on using that as a defense.
Yeah, so-
Well, sure, the sales are legally structured and automated, but they set those plans up at those specific levels for a reason, right? If you're a retail trader who rode this thing down from $193 and you watch the CEO and the COO hit the exits for $10 million bucks each, how does that not completely crush your confidence?
The optics are undeniably damaging, I agree. While Rule 10b5-1 plans are, standard corporate practice for founders looking to diversify wealth or pay taxes, the scale and timing of the selling profoundly impact investor psychology.
Totally.
It creates what we call a narrative void.
A narrative void. Let's unpack that.
So in the absence of actual revenue or tangible profits, the only thing supporting the stock price of an early-stage hardware company is the narrative. It's the collective belief in the future of the technology.
Right.
When the actual architects of that future, the CEO and COO, are actively taking massive amounts of capital off the table, retail investors naturally assume the worst. They wonder, what do they know about the internal timeline that I don't?
Exactly. And it isn't just retail investors getting spooked by that timeline. Let's look at how the big institutions are reacting. The current consensus rating among tracking analysts is technically a moderate buy.
Which is surprising to some.
Yeah, we have 11 analysts screaming strong buy, 2 at buy, 6 at hold, and only 1 strong sell. The average price target sits between $84.30 and $86.32. So the bullish analysts still see an upside of over 30% from current levels.
But beneath those bullish headline numbers, the momentum of the ratings is definitely shifting negatively. The major financial institutions are aggressively slashing their internal projections.
Right, like we saw in late March.
Exactly. On March 26, 2026, UBS Group cut its price target from $95 all the way down to $60, maintaining a neutral rating. Goldman Sachs followed suit, lowering their target down to $65.
Which is exactly where the stock is fighting for its life right now. I mean, it is incredibly polarized. Insiders are cashing out. Massive banks are cutting targets to current levels. Yet over a dozen analysts are still projecting a massive recovery.
It's a huge divergence.
So it's time we debate the core question. Is Oklo truly undervalued here? Or is this a massive value trap for retail traders?
To understand that polarization, we have to look at the structural arguments anchoring both sides. Let's start with the bull case. The analysts issuing those strong buy ratings are completely ignoring today's zero revenue reality.
Because they're looking at the future.
Right. They are valuing the company based on a series of massive future catalysts.
And the crown jewel of those catalysts is their letter of intent with Meta Platforms. Oklo signed a deal to develop a massive 1.2 gigawatt nuclear energy campus, specifically designed to power Meta's AI data centers. But how do you even sign a contract to sell a gigawatt of power from a plant that hasn't been built yet?
You do it through what's called a power purchase agreement, or PPA. This is the mechanism that makes the bull case mathematically viable. Because artificial intelligence requires an exorbitant, almost incomprehensible amount of continuous energy, tech giants like Meta cannot rely on wind and solar because those sources are intermittent. They only work when the wind blows or the sun shines.
Right. AI data centers need constant 24/7 baseload power. They can't just turn off when it gets cloudy.
Exactly. And advanced nuclear is one of the only carbon-free ways to achieve that continuous power.
So Meta essentially signs a forward contract.
Yeah.
They guarantee to buy the power at a set price if Oklo can actually build the hardware to generate it.
Exactly. These multi-gigawatt pipelines of future PPAs make the company bankable. The bulls argue that having a guaranteed buyer like Meta justifies a multi-billion-dollar valuation today.
That makes sense.
And furthermore, Oklo benefits from massive macroeconomic tailwinds like the White House National Initiative for American Space Nuclear Power. They literally have the tech giants begging for their product and government-level policy actively trying to accelerate the sector.
And going back to our earlier point about the balance sheet, the bulls just look at that $1.4 billion cash runway as the ultimate de-risking factor. They don't need to go begging Wall Street for high-interest loans to build these first reactors. The cash is already sitting in the account.
That is the generational opportunity narrative right there. Infinite demand for AI power, a massive cash buffer, and macro tailwinds.
Right, but what about the bears?
The bear case focuses entirely on the brutal friction of reality. The bears argue that having a guaranteed buyer means absolutely nothing if you cannot physically deliver the hardware.
Because Oklo is not expected to consistently materialize actual commercial revenue until at least 2027 or 2028, right? I mean, that is the targeted timeline for their first operational reactor, the Aurora reactor in Idaho, to actually go live.
And 2027 assumes a flawless execution, which is historically unheard of in this sector. The bears highlight the mechanism of FOAK risk, that's first-of-a-kind execution risk.
FOA risk.
Yeah. Building a next-generation nuclear reactor isn't like assembling a car on an existing factory line. It's like trying to invent the very first factory line itself while inventing the supply chain for novel parts, all while regulators watch every single weld with a magnifying glass.
And the regulatory bottleneck here is the Nuclear Regulatory Commission, the NRC. Historically, getting novel nuclear designs approved by the NRC takes years longer and costs exponentially more than initial estimates.
The bears look at that timeline and see inevitable delays. If the Aurora reactor gets pushed back to 2029 or 2030 due to NRC red tape, well, that $1.4 billion cash pile will start to look very small against a burn rate of $500 million a year.
Which brings us back to the trap. If they burn through that cash waiting for regulatory approval, they will have to go back to the ATM program. They will have to dilute the shareholders again.
Exactly.
So what does this all mean? When you look at all of this, the meta partnership, the AI hype, the insider selling, the massive dilution is the word nuclear, just blinding retail traders to the cold, hard math of share dilution.
If we connect this to the bigger picture, it's a collision of a massive, total addressable market against the reality of corporate finance. The world objectively needs clean, reliable baseload energy to support the AI revolution.
Absolutely.
The word nuclear represents a legitimate, necessary paradigm shift in global energy infrastructure. The narrative is very real.
But the narrative of the future doesn't protect your portfolio in the present.
Precisely. The challenge for you, the listener, is to look past the hype of the AI and nuclear buzzwords and focus entirely on the timeline of hardware deployment.
Because timing is everything.
Yeah. A stock can have the most compelling narrative in the world, but if management has to issue millions of new shares while waiting years for the NRC to approve their blueprints, the retail investor's position just gets ground into dust through dilution before the first dollar of revenue is ever earned.
That is a brutal reality, but it gives us a very clear roadmap for how to view this stack of research over different time horizons. Let's pull all this analysis into actionable context.
Let's do it.
If your outlook is short-term, meaning you are trading this over the next few weeks or months, expect this stock to behave like a highly volatile battleground. The technical algorithms are going to chop this around in a wide consolidation range between that $45 support floor and the $70 resistance ceiling.
Right. And you really want to watch how the price reacts in the low $60 where those short-term moving averages are trying to cross.
Exactly. But if your outlook is medium to long term, the daily stock chart is mostly irrelevant. You have to pivot your attention away from the financial engineering and focus entirely on the physical engineering reports.
Yes, the entire long-term thesis rests on hardware and regulatory milestones. Specifically, can Oklo actually navigate the NRC, build the physical supply chain, and deliver the Aurora reactor in Idaho on time by 2027?
Right. And as we lay out that roadmap, we must explicitly state that our deep dive today was purely an exploration of the charts, the filings, and the research provided. Nothing we have discussed here constitutes financial advice.
Wait, no financial advice here.
We are simply unpacking the mechanics behind the volatility to help you understand the forces at play.
Those forces are massive. The market is currently weighing the promise of a technological revolution against the heavy cost of execution.
It really leaves us with a fascinating paradox to consider. We started by looking at a stock that plummeted from $194 down to the mid-$60, leaving a trail of exhausted retail traders in its wake.
A lot of bag holders, unfortunately.
Yeah. So here's the question you have to ponder on your own. If Oklo actually manages to dodge the regulatory red tape and successfully deploys the Aurora reactor by 2027, will that previous $193 all-time high look like an absolute bargain for a company powering the AI revolution?
That's the dream scenario.
Or will the sheer weight of that $1.1 billion share dilution mean the stock price never recovers its past glory, even if the company itself succeeds?